Good morning. A warm welcome everyone to today's virtual event. My name is Brendan Sito and I'm the head of Apac Sales and Account Management at S&P Global Market Intelligence. We really appreciate you taking the time from your busy schedules to join us virtually today. In the last 10 years of hosting these annual forums in major Apac cities, so much has changed, especially in the last 2 years, where the world we are living in has drastically changed due to the pandemic. Many of the markets are recovering, but so much is still happening to impact economies around the world. APAC is no exception. As a confluence of developments alter the outlook, we see that global macroeconomic conditions are worsening, and this is further exacerbated by geopolitical tension, inflation challenges, market volatility, and rising yields. In this current economic climate, how will APAC tread the global path to recovery? You'll hear more on this in our keynote address by our Chief Economist shortly. And for the first year ever, we're excited to be able to bring together experts in many areas across our newly merged S&P Global Market Intelligence and IHS Markit organizations to take a close look at these important developments and the future of the region. This brings me to the theme of the event, which is an era of change, navigating global disruption and transformation. There'll be two parts of this virtual conference taking place now and on the 27th of July. For today's agenda, our speakers from S&P Global Market Intelligence will assess the impact of shockwaves from the Russia-Ukraine war, rising inflation, and deglobalization on the global and APAC economy. This will be followed by an interactive panel discussion where our ESG and risk experts delve into the journey to net zero and the lens of a corporation, bank, and investor. Before I introduce our first speaker, I'd like to explain how the conference is set up. Our two speakers will give their presentations, followed by a Q&A session directly after. At any point during the program, you can ask your question by typing it into the Ask a Question box in the lower left side of your screen. To make the presentation full screen, please use the full screen button on the lower right-hand side of the video window. At the conclusion of day one main program, you'll be directed back to the selection page to choose your breakout. Breakouts will begin after the scheduled break. Our three breakout sessions are third-party risk management, your responsibility, but not your control, evolution of bond market and the role of financial data governance in credit risk management, emerging risks and opportunities in APAC FinTech. If you have not selected the breakout session during your registration, you're still welcome to join any of the sessions today. So with that, let's begin today's program with our first presentation. I'd like to introduce Rajiv Biswas, Asia Pacific Chief Economist, S&P Global Market Intelligence. Today, Rajiv will talk about how global headwinds to the Asia Pacific economic outlook will impact us. Rajiv, over to you.
Thanks very much. I am delighted to be here to present our latest assessment of the global and Asia Pacific outlook. My name is Rajiv Biswas, and I am the Asia Pacific Chief Economist for S&P Global Market Intelligence. As we enter the second half of 2022, the world economy continues to face many challenges. These include the COVID-19 pandemic, the impact of the Russia-Ukraine war, surging in inflation, and ongoing supply chain disruptions. Let me first discuss the latest economic forecasts for the global and Asia Pacific economies produced by S&P Global Market Intelligence. These are based on our global macroeconomic model of the world economy, and our forecasts go out for 30 years, but today I'm going to focus mainly on the near-term economic outlook, at least in the large part of my presentation. If we look at the forecast for the world economy, we expect world growth to be moderating from 5.8% in 2021 to 2.9% in 2022, and a similar pace of growth in 2023. But within that global view, we do expect quite a moderation in growth of US and Eurozone. Both the US and Eurozone are expected to slow quite significantly through the course of 2022 compared to their growth rates in 2021, with further moderation expected in 2023. As I'll discuss later, there are also increasing risks that the US and Eurozone could face recessionary conditions over the next 18 months. Turning to the situation in the Asia Pacific, growth momentum is also moderating compared to the very strong rebound that happened in 2021 when APAC growth exceeded 6%. But it's still quite a resilient outlook for 2022, with Asia Pacific growth estimated at around 4% this year, and actually slightly increasing in 2023 to a pace of 4.6%. And that improvement is particularly expected to be supported by improvement in mainland China as they work through their COVID disruptions that have happened this year. And as those factors start to fade out of the equation, we expect some improvement in mainland China's growth rate to above 5% in 2023. Elsewhere in the Asia Pacific, we expect Japan to be growing at a reasonable pace of about 2% per year this year and next year. And we expect quite strong growth in India. India already had a strong economic rebound in 2021, growing at about 8.7% in the fiscal year. And in the current fiscal year, we expect growth to be 6.8%. So another year of pretty strong recovery from the pandemic. And then going into next year, growth at a pace of around 6%. Elsewhere in the Asia Pacific, we're also seeing relatively resilient performances in Australia, where commodity prices have really boosted the economy. Growth is expected to approach around 4% this year, moderating next year due to the impact of tightening monetary policy, but still growing at around 2.6% next year. In South Korea, we expect growth of around 3% per year this year and next. And in Southeast Asia, we're seeing pretty strong performances in Indonesia, Malaysia, and Singapore this year, as they see quite strong resurgence in domestic demand as COVID-related restrictions have been eased. And so even though the global economy is moderating, we're still seeing relatively good growth in Southeast Asia, and that's expected to continue into next year. Let me now talk for a moment about risks to global growth. Clearly, there are many downside risks to the growth outlook. And of course, front and center is the risk of the further escalation of the Russia-Ukraine war. And that certainly is an important risk for the outlook in the second half of this year. We're also seeing growing weakness in the economic indicators in the US and Eurozone. So there is an increasing risk that the US and Eurozone could enter recession and also continue to be affected by high inflation and the impact of tightening monetary policy. The COVID pandemic is still with us, so that continues to be an ongoing risk. Were there to be significant new variants that delay the recovery in economic activity. And at a global level, the persistence of high inflation could be an important risk if it forces more aggressive monetary policy tightening globally. We're already in an environment where we've seen asset price corrections and stress in financial markets, but if inflation remains high, or indeed if it moves higher, and we see further aggressive monetary policy tightening by major central banks, that environment of weakness in financial markets could intensify, and that could lead to greater problems in emerging markets due to rising non-performing loans and tighter credit conditions. However, there are also upside risks to the outlook, and an important risk on the upside is that if there were effective COVID vaccine and treatments that become more and more well established globally, that could bring a more rapid end to restrictions on activities. Also, if global inflation eases more rapidly than currently expected, that could allow central banks to slow their pace of policy tightening. And I think obviously, if the COVID situation is improving more rapidly than expected, we could see a revival of service sector activity, particularly international travel, at a more rapid rate than in our base case. However, I think it's also important to recognize that the world has been through tremendous changes over the last decade. From the 1950s through to 2010, we were in an era of globalization, and the forces of globalization through trade liberalization, through increasing global investment in international supply chains, through financial markets liberalization globally, and integration of international capital markets, were all driving globalization and greater trade and investment flows worldwide. However, we're now seeing some factors that are working against that. The forces of deglobalization seem to have increased in recent years. And of course, front and center is Russia's invasion of Ukraine, which has driven severe decoupling of Western democracies from Russia. We've also seen growing military confrontation between NATO and Russia. And between the US and China, we've now seen for a number of years trade and technology wars that have also created rifts between the economies, although we're still seeing very strong trade flows between the US and China on the positive side. National populism is also an issue, as exemplified by the UK Brexit. And there are also growing concerns that the global south could fragment into new Cold War alliances. So a number of counterbalancing factors there. So there are still positive forces for globalization, but clearly there are greater forces for deglobalization that have arisen in recent years compared to what we've seen in the past half century. In the Asia Pacific, what we've seen is quite favorable factors driving global trade liberalization. So as world trade liberalization has stalled through the World Trade Organization in recent decades, we've seen the APAC region becoming quite a dynamic force driving trade liberalization through a growing network of bilateral and regional free trade agreements. One of those is the CPTPP, which came into effect in December 2018 with 11 member countries. But now we've also had the UK and mainland China applying to join. And if that were to go ahead, that would very substantially increase the economic size of the CPTPP, making it an even more dynamic force for regional trade. And then another important trade agreement for APAC is RCEP, the Regional Comprehensive Economic Partnership Agreement, which is between 15 APAC countries and came into force at the beginning of this year. So these are positive factors that are continuing to drive greater trade integration and investment integration in the Asia-Pacific region. I would now like to turn to some of the developments in major economies. And what we're seeing is that the US manufacturing sector is showing some moderation in momentum, and it posted a PMI reading according to our S&P Global US Manufacturing PMI Index of about 53 in June, which is quite a big moderation compared to 57 in May. The key benchmark there is the 50 level, which is the threshold between expansion and contraction. So the US PMI is still of 50, so it's still showing expansion, but clearly the pace of expansion has moderated. And if you look at the chart, you can see that in recent months, there's been quite a slowdown in the manufacturing PMI in the US. Again, a signal that as manufacturing is moderating, there's growing concerns that the US economy could be heading into a period of much softer growth. And indeed, if we look at a very important tracker of US GDP, the Atlanta Fed GDP tracker, it signals that the second quarter GDP in the US could be negative. And given the first quarter in the US was also negative, 2 successive quarters of negative GDP growth would put the US economy into a technical recession. So the indicators from the Federal Reserve Bank of Atlanta's GDP Now model do look at a number of subcomponents of GDP, and the latest tracker with data up to the end of June has painted a much more negative picture of the situation in the second quarter, and therefore the risk of US recession has risen quite significantly. The US equity markets outlook has, of course, also been quite negative in recent months. The S&P Global Investment Manager Index, which is based on data from about 100 institutional investors with assets under management of about $900 billion US, has been very negative in May. It improved in June, but still, of course, remained in negative territory, signaling persistent net risk aversion. And the biggest drags on the outlook for the market based on this survey are central bank policy, obviously led by the Fed's aggressive tightening, and no political environment due to the Russia-Ukraine war. So both the US and global macroeconomic environments are viewed as exerting increasing downward forces in equities. Turning to the Eurozone, we're also seeing quite a significant slowdown in manufacturing in June in the Eurozone. The S&P Global Eurozone Manufacturing PMI moderated from about 54.6 in May to about 52 in June. As in the US, we've seen over recent months quite a moderation in manufacturing momentum in the Eurozone as well as in the US. And that reflects weaker demand conditions in Europe. And certainly the Russia-Ukraine war is an important reason that's affected the economy due to surging energy prices. That's affected consumer demand. And the increasing uncertainty is also, of course, a negative factor for consumers. So all of these things have weighed on the outlook for the Eurozone manufacturing sector. If we look at the PMI surveys and we track it against GDP, what you can see here is that the PMI for the Eurozone's a very good leading indicator for Eurozone GDP. And because momentum has slowed so dramatically in recent months, it is signaling quite a severe slowdown in the Eurozone. And that also means that the risk of recession in the Eurozone has increased quite significantly based on our PMI indicators. Another important challenge for the global economy clearly has been global inflation. We have already seen a pickup in global inflation in 2021, particularly in the US and Eurozone, due to this resurgent demand conditions that have affected a number of commodities. But of course, this year, what we've seen is a significant pickup in inflation pressures, particularly driven by the impact of the Russia-Ukraine war on commodity prices, notably energy. So we are expecting world inflation to be much higher this year compared to last year. Last year, world consumer price inflation averaged about 3.9%. This year, we're expecting quite a dramatic increase to about 7%. For the year as a whole on average. And if you look at the US and Eurozone, you can see even more rapid increases in inflation, both in the US and the Eurozone. UK also seeing a very sharp increase in inflation. All of this very much driven by higher commodity prices. But what's of great concern now is that if that becomes embedded in wages, that would drive a more persistent wage inflation spiral, which is why central banks are becoming much more aggressive in trying to contain inflation pressures. The situation in Asia is more mixed. In mainland China and in Japan, we're still seeing relatively low CPI inflation. And given the weight of those economies is about 70% of APAC, that's quite an important factor constraining inflation pressures in APAC as a whole. But in South Asia and in Southeast Asia, we have seen more resurgence in inflation. In India, we've seen inflation picking up to about what we expect will average about 7% this year. And we've already seen the Indian central bank tightening. We've also seen a number of other central banks in the Asia Pacific tightening as a result of increasing inflation pressures. And of course, a lot of this has been driven by materials prices. As I mentioned last year, we'd already seen quite a big upturn in materials prices as the world economy recovered from the impact of the pandemic in 2020. As demand recovered, we saw quite a rise in oil prices and also prices for a number of other commodities. But what we've seen at the beginning of this year, due to the Russia-Ukraine war, is another very substantial upturn in the price of many commodities, notably for energy, but also for metals and food prices. There has been some pullback from that high point in recent weeks, but we'll have to see how sustainable it is. If it were to persist in terms of the pullback, obviously that would be a very positive development in terms of global inflation. But nevertheless, there's a lot of uncertainty about how energy markets will play out. There's a lot of geopolitical factors that are affecting the outlook in terms of oil prices. So even though we have seen some moderation in oil prices, there's still a lot of uncertainty about what will be the next direction, whether they'll rebound in coming months or whether indeed they could fall further. And that will be very crucial in affecting the outlook in terms of inflation developments in many countries around the world. In the Asia-Pacific region, we have seen that many APAC economies are facing rising inflation pressures. I already mentioned that China and Japan, the two largest economies, have seen quite moderate inflation. Malaysia has also managed to contain inflation pressures in the first half of this year. However, we have seen rising inflation in a number of Asia-Pacific economies, including in Australia, India, the Philippines, Thailand, Singapore, and South Korea. And that's resulted in tightening of monetary policy by a number of Asia-Pacific central banks. Before we talk in more detail about the individual countries in the Asia-Pacific, I want to just point out that the Asia-Pacific has increasingly become a very large part of the world economy. If we look back to the year 2000, the Asia-Pacific accounted for about 27% of world GDP. By 2021, that share had risen dramatically to about 37%. So as of now, the Asia-Pacific is about 37% of world GDP and has become a very important driver of global consumer demand. That share is expected to rise somewhat further by 2040 and exceed 40% by 2040. So increasingly, we're seeing this shift of economic momentum from west to east as the Asia-Pacific becomes more and more important as a driver of global growth. And in our forecast for the decade ahead, we do expect that the Asia-Pacific will account for about 55% of the total increase in real GDP in the world. Of course, this will be very much driven by China. Mainland China is expected to contribute about 33% of the total increase in world GDP. But India is also becoming more and more important and is expected to account for about 8% of the increase in world GDP over the decade ahead. Let's look now in a bit more detail at the outlook for mainland China. We did see very strong growth last year as the economy rebounded from the impact of the pandemic in 2020. But in 2022, what we've seen is quite a moderation, more than expected, due to the impact of new outbreaks of COVID which has resulted in restrictive measures being put in place in a number of cities in mainland China during the second quarter of this year. Of course, very much in focus has been the protracted restrictive measures in Shanghai, which affected economic output in Shanghai during April and May. However, those measures have been substantially relaxed, so the situation has improved in recent weeks. But there are ongoing concerns about new outbreaks, and there have been in recent days new outbreaks in other cities. So this remains a risk for the outlook. We're expecting growth this year to be around about 4% for 2022. And based on our assumption that these outbreaks will ease during the remainder of the year, we're expecting next year growth should improve to about 5%, slightly above 5%. But nevertheless, there's a lot of uncertainty about how the evolution of the COVID pandemic in mainland China will affect growth momentum both this year and potentially next year. It remains a downside risk to the outlook. However, we have had some very encouraging results from our survey for manufacturing in China. The Caixin China manufacturing PMI showed quite a rebound in June as production came back to more normal levels in Shanghai, notably, but also in some other cities. But even more dramatic was the rebound that we've seen in the services sector. And in the services sector, what we've seen is a 13-point jump in the PMI indicator for the month of June. Back in May, the reading was 41 due to the impact of severe restrictive conditions in Shanghai, restrictions in other big cities like Beijing. But as these restrictions were eased, we've seen a very big rebound in the services sector, all the way back up to almost 55 in June for mainland China. And that's really signaling quite a dramatic turnaround. If we look back to the data for May, retail sales were actually down 6.7% year on year in mainland China. And in April, were even worse, down 11% year on year. So this rebound is actually very important. If it can be sustained, that would signal quite a turnaround in momentum in the third quarter. But of course, we'll have to see how the outbreaks of COVID evolve in cities over the course of the months ahead. Inflation pressures do remain quite constrained in China, particularly CPI inflation still remains very low. So unlike many other major economies around the world, what that means is that China's been able to have relatively accommodative monetary policy and has actually been able to use monetary policy to stimulate growth, in contrast to what we're seeing in many of the other countries, such as the US particularly. And also on the good news front, what we're seeing that producer price inflation in China has been moderating from where it was in the latter part of 2021 and early 2022. So quite a significant moderation in commodity price inflation. And that's helped to reduce input price pressures on the manufacturing sector in particular in the last couple of months. Turning now to Japan, we've also had some good news based on the PMI surveys for Japan. The services sector PMI in particular showed quite an improvement in momentum in June, reaching a level of 54. Which is the fastest since October 2013. This reflects the rebound in economic activity as COVID restrictive measures were eased after the COVID wave that had hit in the first quarter. The situation has improved considerably. So in Japan, we're seeing quite a rebound in economic activity, which is supporting growth. However, the yen has fallen quite dramatically against the US dollar because of the very different inflation outlook in the US compared to Japan. As I mentioned, Japan inflation conditions are still relatively moderate. So the BOJ has been on hold, whereas in the US, with inflation pressures having risen to quite high levels, the Fed's been aggressively tightening. So that sharp upturn in US yields has helped to increase the attractiveness of US fixed income assets. And what we've seen is the yen has actually depreciated from 115 against the US dollar at the beginning of this year to about 136 by early July. So a very dramatic weakening of the yen, which is actually benefiting Japanese exporters. So it's certainly a concern that there has been such a big fall, but nevertheless, it is supportive for the manufacturing export sector. In India, we're seeing that manufacturing and services are still performing very strongly. The S&P Global India Manufacturing PMI still was very positive in June at a level of 54. But even more dramatically, the services sector actually strengthened to 59 in June, which is signaling extremely strong momentum in the services sector, the highest since April 2011. And that's despite the upturn in inflation pressures in India in the first half of this year, as well as several recent rate hikes by the Indian central bank. So at the moment, momentum does seem very strong in the Indian economy. And as I mentioned earlier, we're expecting growth to be just below the 7% mark for this fiscal year. Turning now to the situation in Southeast Asia, we've also seen that the ASEAN manufacturing PMI produced by S&P Global continued to show a level of about 52 in June, very similar to the reading in May, still showing solid expansion in ASEAN manufacturing. And 6 of the 7 ASEAN nations showed growth according to the PMI indicator for June, with Singapore leading the rankings table. You can see in the chart there, the Singapore PMI has been extremely strong in recent months as the economy has been reopening, domestic demand's been picking up. And similarly, we're also seeing quite strong readings in Vietnam. Vietnam had been hit very hard by the Delta COVID wave in the third quarter of last year, and that had affected momentum even into the fourth quarter. But what we're seeing in the early part of this year is quite strong momentum, particularly driven by a pickup in exports. So in summary, the APAC outlook for the second half of 2022 and for 2023 is still quite resilient despite the slowdown that we're seeing in the US and EU, and also the weakness of China in the second quarter. Nevertheless, the Asia-Pacific regional growth is still forecast to be about 4% this year and 4.5% next year. Clearly, there's downside risks due to rising inflation pressures in a number of Asia-Pacific economies. And a key concern is how the COVID situation will evolve in China. So that also remains an important uncertainty and downside risk for the APAC outlook. But overall, we're still expecting quite resilient growth in a global environment where growth is moderating quite significantly. So with that, let me conclude my formal presentation. And I would now like to open up for Q&A. There are a few questions that have been submitted by the audience. So let me address the first question, which relates to the situation in terms of a scenario where there were to be recessions in the US and EU over the next 18 months. And how would that affect the APAC region? Well, as I mentioned just now, we do expect in our base case scenario that APAC will be growing at around 4% this year and 4.5% next year, very much based on a quite resilient performance in South Asia, notably India, but also in Southeast Asia. And also Japan expanding at quite a reasonable pace. But a key potential risk is what happens in China. So the strengthening growth momentum in the Asia Pacific for next year is based on some improvement in momentum in China. So I think if we were to see the scenario where the US and the EU were to slip into at least technical recession, a lot will now depend on what happens in China. So if there is a technical recession in the US and a similar kind of evolution of momentum in the EU, a rebound in China in the second half of this year and early next year could help to mitigate the negative impact. However, if we were to see weakness in China as well, that would then have quite negative flow-on effects to the rest of Asia. So I think the resilience that we're seeing in Asia, or the whole of the Asia-Pacific region, has been very much supported by the strength of domestic demand in some of the major economies. But clearly, if we do see the US and EU slipping into a recession, that would affect Asia exports to both of those key markets. And then if there were to be a rebound in China, that could mitigate that impact. On the other hand, if we were to see a scenario where you have recessions in the US and EU, but also weakness in China due to COVID outbreaks, that would then create a more negative outlook for APAC. Although given our forecasts of 4% this year and 4.5% next, it would still probably be a scenario of relatively resilient growth, but it would be somewhat softer than currently expected. So let's now turn to some of the other questions. We have got another question here about the shocks from rising inflation and monetary policy tightening on the emerging markets in APAC. How severe are these shocks likely to be? I think, as I mentioned earlier, we are seeing quite different impacts across Asia. Some Asian countries still have relatively moderate inflation pressures, notably China and Malaysia have still got relatively low inflation, whereas some of the other developing countries in Asia, such as India, Thailand, the Philippines, are seeing rising inflation pressures. And so those countries are likely to have to tighten more significantly than what we're seeing playing out, say, in China. So I think it's really a situation where there's different impacts on different countries. But I think, having said that, it's also important to recognize that there are some very fragile developing countries in Asia that already had significant problems in terms of external debt and also very weak foreign exchange reserves, even in 2021, before the onset of this surge in inflation pressures this year. And what we've seen this year is that some of those economies have been hit very hard by the surge in inflation pressures, particularly for French. And I would particularly highlight Sri Lanka, Pakistan, Laos as being among those fragile countries which have very high external debt and have now seen their foreign exchange reserves weaken considerably at a time when oil prices are surging. So particularly in Sri Lanka, what we've seen is that as their foreign exchange reserves have been depleted, they've been unable to even afford to pay for oil imports. And the country has really been very badly hit by running out of oil supplies, even for essential transport. So, that shows you that there are fragilities in some countries in the Asia region. But I think on the whole, what we're seeing is that there's a lot of resilience in many of the countries, particularly in East Asia, because many of the developing countries in East Asia have a relatively strong external account position. They have strong foreign exchange reserve and strong macroeconomic fundamentals. And I think that reflects many of the reforms that have happened since the East Asian crisis over many decades. So we're seeing many of the East Asian countries still in quite a resilient position, able to withstand these international shocks that are hitting the world economy this year. We have also a question about supply chain movements and what is the impact of supply chain disruptions on supply chain locations around the Asia-Pacific region. And I think what we've seen in response to that particular question is that supply chains have already been, I would say, shifting in the Asia-Pacific region away from China towards Southeast Asia, and to some extent also to India over the last decade because of rising wage costs in China. But the pandemic has, I think, intensified those pressures, because when we saw that tremendous disruption in Chinese economic production during the lockdown in the first quarter of 2020, many multinationals recognized that they had a lot of vulnerability to that kind of disruption in China. And then, of course, we've seen somewhat of a repeat of that in recent months when we've had restrictive conditions in a number of cities in China this year as well. So I think one of the trends that we're seeing is supply chains are shifting. Multinationals do want to diversify their supply chains. China will still be very, very important. It's the world's second largest economy. So firms will still have a lot of production in China, but they are also diversifying geographically. And one of the big winners will be Southeast Asia. I think countries like Vietnam, Malaysia, to some extent Indonesia and Philippines will be winners over the next decade. We'll also see wider diversification to India. That's already, I think, underway in sectors like autos, electronics. We're seeing much more investment flows going to India. So I think the focus will be on geographical diversification to reduce the vulnerability of supply chains to particular geographic locations. And I think many Asian countries, particularly in Southeast Asia and also South Asia, will be winners of that structural trend over the decade ahead. Due to time constraints, we have to now close this session. However, please do reach out either to me directly or to your client relationship manager if you have any follow-up questions, and we'll be very pleased to continue the conversation. With that, I will now hand over to Edward, Michael, and Prerna for the next session, which is on the topic of the journey to net zero. Thank you very much.
Hi, everyone. Good morning, and welcome to this panel entitled The Journey to Net Zero, from the lens of a corporation, bank, and investor, which is part of S&P Global Market Intelligence annual virtual conference. My name is Olivier Trecco. I'm the head of ASEAN, Japan, and Pacific ESG Solutions at S&P Global Sustainable One, and it is my pleasure to be the moderator for this session today. So now we certainly recognize that this topic is of great interest for many of you. Net zero and carbon neutral commitments keep rising in 2022 as companies and countries assess their alignment to global climate goals. In line with these commitments is an impressive array of net zero target setting frameworks, such as the Science Based Target Initiative, SBTi, or the many net zero alliances under the umbrella of GFANZ, which is the Glasgow Financial Alliance for Net Zero, of which actually S&P Global is a member. The reality is that the challenges to meet those targets are very specific to the nature of the company that will make the commitment. A non-financial corporate will have different frameworks and different concerns from the bank that underwrites loans to it, and again, from the asset owner that invests in securities from all of them. To reflect on the very specific nature of these challenges, I have the pleasure to welcome three distinguished panelists on today's discussion. First, we have Edward Soon, Head of Issuer Solutions Asia Pacific at S&P Global Market Intelligence and based in Hong Kong. And Edward will be focusing more on the corporate side. So hi, welcome, Edward. And then we also have Prerna Divecha, Global Lead Market Strategy and Development for Climate-Linked Credit and Risk Solutions based in Singapore. Hi, Prerna. And Prerna will be taking more of the banking lens. And last but not least, we have Michael Salvatico, Head of Asia, Pacific, Middle East, and Africa ESG Solutions at S&P Global Sustainable One. Michael will focus on the perspective of the investor/universal owner. Before we start, I just want to note that this panel is recorded, so we will have an on-demand version available shortly after we conclude. So if colleagues of yours, friends, or even family are interested to watch that panel, please do share that link. And finally, we will have about 30-minute discussion followed by 10 minutes Q&A. We'll be taking live questions. If your question does not get answered through the session, we will make sure to reach out to you in writing to have your question answered. So now, without further ado, I want to start with a question to Edward. Edward, speaking of corporates, what are the major challenges for corporates as they think about their net zero journey?
Morning, Olivier, and thank you very much for that question as well. I think definitely net zero in ESG more broadly as well is definitely top of mind for everyone these days. The pressure on financial market ecosystem to adapt, including for corporates, it's increasing. And definitely, I think from the corporate perspective, we are definitely hearing a lot more questions coming through as to how they can adapt for this journey going forward. I think from a corporate perspective, a couple of things stand out. One of it is the constantly changing regulations and expectations, not to mention the variety of stakeholders that are taking a deeper look at this topic. There's an increased demand for disclosure and transparency. And also as more and more data becomes available, there is a lot of data, but there's also a lot of demand for even more information and data by the different stakeholders in the market. Internally, there's a very real practical challenge about collecting information that can help them drive the decisions and investments that they need to make in order to achieve carbon neutrality and net zero. Identifying material factors is not something that companies that are used to producing goods are thinking about typically on a typical day. So it is a very much a change in mindset. And that change in mindset really has to come from the top down, from the board, from the chairman. Culturally, there needs to be a big shift within the organization. And it's not just about ticking the box on disclosures, but it's also for companies to realize that there are opportunities in play. And those opportunities potentially can help the companies grow to the next level as well.
Okay, thanks. So you mentioned quite a few, stakeholders being involved. Let's take a step back, if you don't mind. Who are then these, many and varied stakeholders you talk about?
Yeah, you mentioned a bit of that in the introduction as well, and my comment is, who isn't a stakeholder today, right? If you think about it, the capital markets investors, and I'm sure Michael will cover a lot of that today as well. It doesn't matter whether you're a passive or an active owner of shares and equity. There is an increase in the demand for active stewardship and definitely active engagement as well by institutional investors. The banks and Prerna, I'm sure we'll talk about this as well, the financing and enabling of deals for companies. How do you look at risk from that perspective and perhaps opportunities as well? From the corporate side, there is the supply chain question as well, from suppliers through the customers and through the customers of customers. What are their expectations? And these are also very much stakeholders in the overall equation. Needless to say, regulators and governments. But one piece that sometimes people forget will be internally the employees as well. The race to attract talent. There is a change in demographics. There's a change in preferences as to how the millennials and the younger generation look at job opportunities and the way that they consume as well. All of them have an interest in climate initiatives and definitely have a lot of interest in disclosures by companies.
Okay, well, it's good you mentioned disclosure because that's my next question. We hear a lot about disclosure, and especially, corporates going into this net zero journey have a lot of questions about ways and how to disclose. Could you perhaps give us a bit more details about those various disclosure regimes and how they apply to corporates?
Yeah, definitely. I mean, the disclosure labyrinth, as we call it, is challenging. It is complex, and it's probably going to increase in complexity as well. Regulators and governments are coming down with top-down sort of approaches and guidance for companies that are out there. There are framework and standard setters, your TCFD, your securities exchanges that we're seeing around the world now taking a very active role in this space, the protocols, your GHG protocols. There are coalitions and initiatives you read about in the press every other day, whether it's UN and PRNI, Climate Action 100. And then there are the ratings providers, and there's a plethora of them out there in the market. I think one of the early complaints we had from many corporates when surveys started getting sent out was, well, which survey do I respond to? And there's so many of them, and these surveys get longer and longer every year as well. So definitely the disclosure labyrinth is increasing. It is complex, and that's really where, potentially, companies and players in the market need to look at how consolidation can occur to make it easier for everyone to disclose and also to consume that information as well.
Okay, thanks. So now we have, in a way, set the scene. We have the stakeholders, we have the challenges, we have the disclosure regimes. So now let's, if we could have some concrete snapshots about, what are the first steps and the next step that companies can do to start the journey on the net zero, towards the net zero commitment.
Yeah, definitely. We take a look at it from sort of 3 stages, and I'm oversimplifying this. Obviously, there's a lot of different work streams and things that need to be done. And the 3 stages we look at are really the first one being the diagnosis, and that's really analyzing your position and profile as a company today, as well as the environment that you're in. The second one being sort of the design phase, creating that roadmap. And the implementation of the strategy and the decisions that you decide to take. And then the third part of it, which again links to the disclosure, is really that engagement part of it. How do you disclose? How do you engage about the topic with your stakeholders? How do you measure it, and how do you report those things out to the different stakeholders? So I'll cover a couple of this in brief. So diagnosis, it's really about benchmarking, looking at the gap analysis between yourself and perhaps your peers, and your industry groups as well. So there's already a lot of information that's out there in the market as to what companies are doing and how they're performing. And it is an opportunity for corporates as well to start looking at how they can benchmark themselves, perhaps against some of the industry and peer comps in the market. Understanding material factors, looking at what data sources you have internally within the firm, but also looking at externally as well, and how you can incorporate both data from the markets as well as data operationally within the firm in order to figure out where you are in terms of the overall journey itself. The third part to it, which you mentioned earlier on as well, is the board and management readiness, as well as the acceptance for the changes that are needed as well. That transformation of this size and that whole transition can only occur and can only occur successfully if it is something that is committed from the very top all the way throughout the entire organization. And that's really that diagnosis phase itself. The second part to it is the design. So you're looking at the roadmap and the implementation of the strategy. Probably TCFD is going to be the best framework here when you look at the 4 pillars around the governance, strategy, risk, and metrics and targets. Strategic decisions have to be made on investments potentially have to be made. And these all have to be done over a period of time as well. So strategy needs to be put in place, whether it's over the next 5, 10, 15 years. Those decisions have to be made at some point in time very, very soon. Internal gathering of data, systems, and processes. Again, companies are very good at producing goods. To what extent can they take that information and use it for different purposes now? And to look at it from an operational standpoint and efficiency, as well as the demands, again, of the external stakeholders. That potentially will lead to the setting of the science-based targets, as you mentioned earlier on, Olivier, is making very informed decisions, very strategic decisions based on information that is available to you. But information is information, data is data, and numbers are numbers, just like financial numbers. It's the narrative then that becomes the next stage for the companies. How do you think about disclosure and engagement, which is that third part to it? Understanding stakeholder expectations. I'm sure Michael and Prerna will cover as well that, there's a lot of information a company can disclose, but what is material? What is going to be important to the different stakeholders out there? Having that deep understanding will then help you to drive what we call the narrative and the story behind it. That narrative is critical. It's one thing to put out numbers, but it's another thing to tell the narrative and the story as to the journey that you're potentially going to go forward with. That story is going to help external stakeholders understand and get a view or be as a lens into the actual company itself, how they think, the culture that's within the firm itself, and how they deal about the issues and the topics going forward. And then finally, it's really around the measuring and reporting of that progress, setting off those goals, the short, mid-term, long-term objectives, and being able to report and communicate the progress against it together, again, with that narrative. So I would probably say, based on those three things, looking at diagnosis, design, and engagement, that's really going to help a corporate at least get started on that journey. And ultimately, financial markets will play a very big role, and not just as consumers of information, but they will become that change agent to drive these initiatives going forward in partnership with many of these companies. So, look forward to definitely obviously hearing more from Michael or Prerna as well, their perspectives from different stakeholders.
Thanks a lot. Thanks so much, Edward, for those thoughts. It's very insightful, and actually it's a great transition. I'm turning my attention to Prerna. And so we've had a very in-depth view about corporates and their whole journey. We already have that very insightful view about this. I wanted, Prerna, to have your views on how specific is the banking net zero journey. I know you focused on the integration of climate risk and credit risk. If you could tell us, give us a bit more insights on the specificities of the banking journey. I think that would be very interesting for our audience.
Yeah, sure. And thanks for the opportunity to speak at this event, Olivier. You're right. I mean, you already alluded to the point that climate risk for banks is essentially credit risk. And this is because when you are thinking about climate risk from the lens of a bank, it largely refers to their capability to manage their financed emissions in a way that it complies with their own strategy on net zero, and also facilitates the transition to a greener economy in a way that it also doesn't increase credit risk. Why I say that is because climate transition is going to be facilitated, and we know this already, to a large extent by the introduction of increase in carbon taxation and investments in green technology. So for a bank that is lending to a corporate, and that obligor, it is really a double whammy. That is going to erode near-term liquidity for the corporate because of increase in carbon taxation levels, and also put pressure on their debt service capability as they make new investments in greener technology. Banks tend to look at leverage ratios, the amount of debt you have to the amount of equities and cash flows you have, and when an obligor is obviously faced with both increase in carbon taxation as well as their intent to become greener, that in itself creates a credit risk challenge, and hence why, if you think about climate risk for banks, we're essentially talking about a direct impact on the creditworthiness of obligors of that bank. So the obvious challenge really lies here in the analysis of the impact of climate-related risks on loan and investment portfolios, which in fact is for the purposes of quantifying the impact on credit risk. However, if, in contrast to general credit risk assessments that banks are used to, we think about climate-related credit risk analysis. We're actually talking about very long-term horizons here, much beyond conventional stress testing exercises that banks are used to conducting. From a credit modeling standpoint, there's also a very unique challenge if you think about it, as it is, influenced, by varying carbon tax levels, varying policies by countries, by industries, and also the speed of implementation of carbon tax evolution over the next 30 years. So what we're seeing is, the climate science community, such as the NGFS and the IPCC, providing scenario-related variables, alluding to various types of temperature pathways, macroeconomic factors, changes in, corporate and consumer behavior, different policy actions, and all of these can then be used to develop an approach to quantifying the impact of climate on credit risk. And this is something we're also doing at S&P, to be honest. We have offerings such as climate credit analytics, which can assist banks in doing that analysis. I guess the last point I would make here, on this topic is, we've seen the effect of climate risk flow into credit risk, but it is not yet flowing into the expectation from banks to create additional provisions or capital buffers just yet. So at this point for banks, it's about climate-related stress testing, and then sort of moving over also onto the reporting side, which is in line with Basel's Pillar 2 and Pillar 3, but not yet sort of impacting capital calculations. So we're watching the space.
Thanks. That's very interesting, and it is true that it's been a complex journey for banks. There are many drivers: regulation, peer pressure, customers, risk. I think is the key driver, as you mentioned. And actually, because you've been talking a lot about risk, and obviously, for banks, credit risk being equated with climate risk is the first natural driver. I wanted also to have your views on the other side of that coin, which is the opportunities aspect. What does the net zero journey have to say about identifying opportunities in the transition financing for banks? Not just about managing risks, but also getting ready for the future and being able for banks to actually make the future happen and finance those transition enhancing activities.
I'm glad you bring that up, Olivier, because one largely tends to focus on risk when you think about climate-related transition, but there are actually also opportunities for financing the transition, and that we mustn't forget, right? There are some big areas and obvious areas, including not only renewable energy, but also batteries and storage, which will be important elements of advancing the energy systems of the world. So really there are, opportunities that, one can finance along this transition. Companies that are ahead of the curve in their ability to adopt green technology, they will gain efficiencies sooner to reduce costs, and ultimately even to seize market share from their competitors. Or for companies in certain sectors altogether, for example, power generation, which has been the fastest to decarbonize globally. In addition, I'd say when we look at sectors that are very heavy on greenhouse gas emissions, like aviation, shipping, manufacturing, steel, there are a lot of opportunities for innovation, and innovation requires financing. So in the aviation space, as an example, there's a lot of work going on sustainable aviation tools. There's also work around reducing emissions in the shipping industry, potential role of hydrogen or green ammonia in helping to decarbonize the shipping industry. So in each of these areas, there's opportunities for financiers who can help accelerate the funding of those breakthrough technologies, EVs, as we saw the advent of electric vehicles in the automotive space. Because in the end, to really rework all of these energy systems, there's going to be a tremendous effort and a significant increase required in the mobilization of capital to really get the outcome, that the overall sort of finance community and the world is seeking from green transactions.
Thanks, Prerna. And actually, I love those last words, because this is really showing the urgency and the mobilization aspect. We need to mobilize all capital, and so through this discussion so far, we've had the point of Edward, on corporates, and then being financed by obviously loan underwriting from banks, all following this. We see this increasing net zero journey, and Prerna just mentioned the urgency to mobilize all kinds of capital, which leads me naturally to the, I would say, the ultimate role of investors, or the universal owner, which is investing in all those securities issued by all parts of the economies. And so, Michael, I'm obviously turning my attention to you, and we're having these discussions about, everyone is jumping to the net zero framework, and for risk perspective, for commercial, for regulation, for clients, from peer pressure. I would say my first question to you would be, what actually are the risks today, not of committing to net zero target, but of not committing to a net zero target for an investor?
Yeah, thanks, Olivier. And thanks everyone for being here. It's a real pleasure. And it's a pleasure to have the investor focus. I've been working with investors for 20 years, and in particular with asset owners on sustainability for the last 10 years. We've seen that increased focus on climate change. So your question on net zero is very relevant to investors today. Investors have a great responsibility. The asset owners, especially the universal owners, have an incredible responsibility. They're the allocators of capital, and the environment in which we're in, as you heard from both Ed and Prerna, is changing, and the ways and the incentives, the return perspectives for investments is changing. In fact, you can say that today business as usual is making our planet unlivable. And with that lens, the importance of how investors are taking into account climate change and that accountability for a transition to net zero is critical. The asset owner's role is the same, and that is to maximize return for their members and clients. In places like Australia, it's written into law around the sole purpose test, and that means that with the impacts of climate change, the focus needs to be greater on how they're managing those risks and opportunities. In fact, you could see the clients that we're working with in the asset owner space who are leaders in understanding these risks and in tilting their portfolios away from risks towards opportunities, are less focused today on divestment and more focused on engagement and impact in their investing in order to drive that transparency and transition to a net zero future. It's rapidly changing as well. So the risks of not committing to net zero, the importance of net zero has increased, if you like. Back in 2021, we had a roundtable event where we invited asset owners to come together and talk about their concerns around climate change. And at that stage, one of the key points that came out was that their asset owners were in between regulators, climate change, and members, that they weren't necessarily aligned in their aims and in their direction. That paper is available online on the S&P website for those who are interested. Asset owners' perspectives on climate change. I encourage everyone to have a look. It's a really good insight. What I've seen is that, or what the market's shown us, is that there's been a change in both the understanding of climate change in general and the understanding and attention given by regulators. And some of these changes have only happened in the last week in some countries. I think from a climate change perspective, we've definitely seen an increase in climate change related disasters linked to an increase in man-made carbon emissions. So that's fairly clear. So if we think about not having a net zero target, well, given that the science is more widely accepted, there's more concern and more pressure on asset owners to have that net zero target from a reputational risk perspective. Where we note that the number of weather-related disasters has risen, and in one of the articles that we have for our corporate sustainability assessment, we indicate a 5 times increase in those weather disasters from 1970 to 2010. And there's a UNDRR report which shows a twofold increase in the intensity of those natural disasters over the last 20-year period. we've all seen or unfortunately been part of the consequences of these climate change driven natural disasters, with massive economic losses exceeding 1.3 trillion in that 2010 to 2019 decade. This has a direct effect on the ability of asset owners to meet their goals of maximizing returns for members if they're not taking into account these climate risks and if they're not managing these climate risks. Unfortunately, today, when we analyze the market, we see that there are no sectors in Asia which are aligned to a 1.5 degree scenario. And that 1.5 degree scenario, just to make the connection for those listeners, is a really important target to reach if we are going to achieve net zero. A 1.5 degree target means that investors, companies, banks are all reducing their emissions to a trajectory which minimizes the unavoidable emissions that remain and then offsetting those. But we're in a situation at the moment where no sectors in Asia Pacific are achieving that 1.5 degree target. We also know, as a consequence of climate change, that the financial cost of not adapting could be high. So from an investor perspective, their portfolios of companies which give them exposure to high carbon sectors could be exposed to massive disruptions as those businesses change and as new businesses come into effect. So again, asset owners who don't have net zero targets are unlikely to be bringing these changes into their strategies. There's also a direct financial cost, or a potential direct financial cost. For instance, if we fail to align to 1.5 degrees, or if we fail to align to Paris, the likely consequences are a policy reaction. That policy reaction could be a carbon price. A global carbon price is what our clients are concerned about. So they ask us to analyze their investments and their portfolios through analysis. We do a carbon earnings at risk, an unpriced carbon cost, which identifies that if you look at the largest 1,200 companies, it could be as much as $283 billion in carbon price costs. That's 13% of earnings at risk by 2025. We're in 2022 at the moment. We're not talking about risks out to 2100 or 2050. These are risks within the timeframes of the people who are employed to manage these portfolios today, to direct these companies, to be the chairs of boards, to be in the banks allocating capital. And we know that this is important also from an understanding of the physical risk impacts on the assets that these companies have. And it could be as high as 2 in every 3 companies in those large companies, 1,000 companies, which have at least one asset at high risk of physical risk. So an asset that could be significantly impacted to the point of shutting down because of a physical risk. So again, those asset owners who aren't taking into account net zero targets are less likely to be taking into account these risks into their portfolios. And if we look at what is happening today and we look into the portfolios of companies, well, unfortunately, there's 1/4 of companies that we surveyed in our corporate sustainability assessment which identify climate change as a material risk. So look, maybe that's a positive in that 1/4 is much higher than it was 2 years ago, but this is the exposure that asset owners have through their investments, and why that engagement and that the initiatives that we see to not only have net zero targets for the asset owners, but also for their companies that they're investing in is very important. Now, I mentioned before that there's also been a change in regulator behavior. So we're seeing an incoming increase in mandatory disclosure rules across the world, not just in Europe. We're sitting here in Asia Pacific. We're seeing those regulations in places like Hong Kong. We're seeing, the regulations in Japan around corporate governance guidance. And we're hearing in Australia in the IGCC conference last week, we had Chris Bowen, the Minister for Energy and Climate Change, indicate that mandatory reporting for large emitters was on the cards, something that was being investigated. So this is also a pressure for investors. In fact, the SFC mandatory reporting in both Hong Kong and in New Zealand will include large investors as well. So that's been a big change since that roundtable session that we did in 2021, and I think shows that having a net zero target is increasingly important, and the risks of not having that net zero target, as we said, potential financial impact, but also reputational.
Okay, great. Thanks, Michael, for this very detailed response. I think there's a lot to take from this. I mean, there are so many reasons, and this is why we are witnessing such a profusion of activity in this respect, and it's very comforting and reassuring, that the corporate and the financial sector is taking this so intensely. We have time for a couple of questions from the audience. So let me perhaps, so everyone can answer. Perhaps this first one might be maybe a bit more for Prerna, but it's an open Q&A session. So we have a question from the floor on Prerna. Talking about net zero targets for banks and moving to decarbonization. How do you make sure in this process, and we talked about financing opportunities, how do you make this work together? How do you make sure that you do not just divest to low carbon activities, and move the problem away to someone else?
That's a very tricky one, because there is obviously a short-term impact if you continue to, finance activities on decarbonization, but in the long term, will see or reap the benefits of it as a banker to the obligor. It's not to say that we stop financing the major sort of oil and gas producers or power generators in the traditional generation space. I think technology is really helping in the sense that even for those coal miners that are reinventing and shifting to natural gas, as next steps, and not yet to renewables, there's even that journey that banks can be a part of, and I think it's not an immediate shift to decarbonization, but as net zero is a journey, so is decarbonization, and hence why I think this is not going to be in the next 2, 3, 5 years. I think it's over the next 10 to 15 years, and while banks and regulators are seeing it through, and that's why there's no sort of real sort of heavy impact on capital needs or capital requirements in terms of additional buffers or in terms of additional provisioning that banks need to do at this point in time. So I think it is acknowledged that this is going to be a journey. It's not about just financing a decarbonization activity today, but it is going to be the journey of decarbonization that banks will look at adhering to.
Okay, thanks a lot. I think we have questions.
Can I jump in there? Yeah, Olivier, because that is a great question, and the views of investors have progressed in the last 5 years, even in the last 2 years, you could say, to a recognition that we need to transition the entire economy, not just the parts that we like. So there's been less focus on divestment and more focus on engagement, bringing along all parts of the economy, including those parts which have historically, in the last 5 to 10 years, a little bit of history, have been those that have been divested from in order to reduce your exposure to climate risk. You know, for instance, we know if we look at the S&P Global BMI as an index, you can drop, let's say 2 handfuls of companies, and you've reduced your exposure to stranded assets, significantly reduced your exposure to stranded assets, because there's only a few companies that have, within a few companies you have very high exposure. But what we're seeing today is that they're all part of the story for decarbonisation, and we need to have the energy mix continue to work for us to provide the energy that we need in order to produce the goods and services and maintain living standards. But at the same time, we need to rapidly reduce that exposure, and so we are seeing this happen in the market. So there's some analysis on where the net zero targets are by sector, and in our review where we look at, most companies aren't setting the basic climate targets, but the companies that are the ones that are high emitting with homogeneous emissions profiles. So we are seeing net zero targets in utilities, energy sectors coming out as the highest proportion by sector in our corporate sustainability assessment. And again, this is something that companies are participating in to provide information which allows investors to have a standardized data set and assessment in order to be able to look at their portfolios and identify which companies they should be engaging in more than others.
And then Olivier, I think Prerna touched on it in her earlier comments as well about innovation and the financing of innovation, right? If we think back 10 or 15 years ago, electric cars weren't something that we would have thought about, right? And today everyone thinks about buying an electric car. But that transition of moving to electrification takes a while because you have to build infrastructure. It's not just about producing batteries, it's about producing the cars, the charging networks and everything else. And all that requires a lot of investment, and it takes time to build those investments as well. So as we think about the whole journey and trying to get to that net zero, as Michael said, it's a collective thing. You can't just pick one industry and say that's the one we're going to divest and move into here. The reality is we have to look across the entire economy and collectively look at where portions of benefits can be obtained throughout the entire supply chain, all the way through to the financing, all the way through the investment process as well.
Thanks to all of you. And actually, on those last words, I think we've actually come to the end of our session. Thank you so much again for our 3 panelists today. Again, for the audience, this session will be recorded and available. I believe that now we are going into breakout. So thank you again so much for your attendance, and have a great rest of conference. Thank you very much.